Are you ready to embark on a thrilling journey through the world of stocks, uncovering the insider secrets to maximize your gains and steer clear of dangerous pitfalls? If so, you're in for a treat. Welcome back to Wealth Expedition Channel, where today we're going to unveil the top 10 mistakes that can suck your hard-earned money out of your pocket faster than you can say bull market. So grab a pen, take notes, and let's dive headfirst into the mesmerizing world of stock market wisdom. Today, we've got a topic that every investor, from the novice to the seasoned expert, must understand to navigate the stock market successfully. Whether you're an aspiring Warren Buffett or just dipping your toes into the investing waters, we've got your back. Today, we're going to discuss the top 10 mistakes that people often make when investing in stocks. These mistakes can be detrimental to your financial health, and that's why we're here to empower you with knowledge so you can confidently make sound investment decisions. The first mistake should be have a plan in investing. Not having a plan. Imagine setting sail without charting your course or knowing where you're headed. It's like wandering blindly through a dense forest, hoping to stumble upon treasure. To safeguard your investments, you need a well-defined plan that aligns with your goals, risk tolerance, and investment horizon. Your plan is like your investment GPS, guiding you through market turbulence, helping you make informed choices, and ensuring you stay on track to reach your financial destination. Let us reveal a well-thought-out investment plan that will help you determine your financial goals, assess your risk tolerance, choose the right investments, monitor your progress, make adjustments as needed. Without a plan, you're more likely to make impulsive decisions that could jeopardize your financial future. So don't wait any longer. Start working on your investment plan today. Now let's talk about the second mistake, which is the undeniable power of diversification. Picture your investment portfolio as a beautifully diverse garden, teeming with various plants of different shapes and sizes. If one plant doesn't thrive, others will blossom and keep your garden vibrant. Similarly, by spreading your investments across different assets, like stocks, bonds, and commodities, you shield yourself from overexposure to a single company or sector. Diversification is your shield against market storms, safeguarding your wealth and minimizing risks.
Going forward in our list is third mistake, skipping the homework.
Would you buy a car without knowing its mileage or condition? Of course not. The same goes for stocks. Before investing in any company, arm yourself with knowledge. Dive deep into the company's financials, growth prospects, and industry trends. By doing your research, you'll be better equipped to make informed decisions and weather market uncertainties with unwavering confidence.
Let's move on to the number 4th in our list, the buying high and selling low.
Picture walking into a store, seeing an item's price skyrocketing, and rushing to buy it, only to sell it at a loss when its price dips. It's a frustrating cycle that can cost you dearly. Instead, let's adopt the mindset of a value hunter. Focus on identifying undervalued stocks with substantial growth potential. Remember, patience is your ally in the stock market game, and opportunity often knocks softly.
Further in our list at number 5th is trading too much.
Do you find yourself glued to stock tickers, anxiously buying and selling at a rapid pace? You might be committing mistake number 5, excessive trading. Frequent trades rack up commissions and fees, eating into your returns like a swarm of tiny piranhas. Embrace a long-term perspective, resist the urge to overtrade, and let your investments grow steadily like a well-tended garden. Remember, slow and steady wins the race. After discussing the first 5,
we have a next on our list at number 6, following the herd mentality.
Treacherous path that can lead to investment disaster. Just because everyone else is jumping on the bandwagon of a hot stock doesn't mean it's the right move for you. Stay true to your investment plan. Analyze opportunities independently and make decisions based on facts, not emotions. After all, you wouldn't want to follow a flock of sheep over a cliff, would you?
At number 7th on our list is chasing performance.
We've all heard the famous phrase, past performance is not indicative of future results. Mistake number 7 is chasing past performance. A stock that's had a meteoric rise might captivate investors, but it's essential to focus on a company's fundamentals and long-term potential rather than its past glories. Remember, diamonds are formed under pressure, and the best investments often reveal themselves over time.
Mistake number 8 is not taking profits when you've achieved your investment goals.
Holding on too long can be just as harmful as selling too early. Mistake number 8 is not taking profits when you've achieved your investment goals. Greed can cloud your judgment, causing you to miss out on realizing gains. Celebrate your successes, sell when you've reached your targets, and use the proceeds wisely for future opportunities. Remember, it's okay to take a victory lap.
The second to last mistake on our list is not paying attention to fees.
In the world of investing, fees may seem small, but they add up over time, like water carving intricate patterns in stone. Be vigilant and understand the fees associated with your investments. By doing so, you can keep more of your hard-earned money working for you, propelling you toward your financial dreams. Let's uncover some of the fees you should be aware of. Management fees. These are fees charged by investment managers to oversee your investments. Trading fees. These are fees charged by brokers when you buy or sell investments. Commissions. These are fees charged by brokers for their services. Load fees. These are fees charged when you buy mutual funds or exchange-traded funds, ETS. 12 Bits 1 fees. These are fees charged by mutual funds to cover marketing and distribution costs. Expense ratios. These are fees charged by mutual funds to cover operating costs. It is important to compare the fees associated with different investments before you invest. Even a small difference in fees can have a big impact on your investment returns over time.
And finally, number 10th is, let's talk about playing the long game.
The stock market might be a roller coaster ride in the short term, but history shows that it trends upward in the long term. Mistake number 10 is not investing with patience and a long-term mindset. By embracing the power of compounding and staying committed to your investment plan, you increase your chances of achieving your financial dreams, like a persistent river carving a magnificent canyon. There you have it. The top 10 mistakes when investing in the stock market should be: have a plan, undeniable power of diversification, skipping the homework,
Buying high, selling low.
trading too much, the herd mentality, chasing performance, not taking profits, not paying attention to fees, not investing for the long term. Armed with this knowledge, you're well prepared to navigate the market with confidence and avoid the pitfalls that many fall into. Remember, investing is a journey, and it's okay to seek guidance and grow along the way. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you won't miss our future videos. Thank you for visiting the Wealth Expedition channel. Stay tuned for future financial education videos.